Picture this, mate, two blokes, same job, same hours, same boss, even using the same tax return software. July 2026 rolls around, one of them checks their payslip and thinks, yeah, barely noticed anything. The other one looks at their bank account and realizes there's actually a bit more money sitting there. No promotion, no pay rise, no side hustle, just a little extra cash. So what's the difference? Why did one person notice it while the other didn't even realize anything had changed? See, this is exactly where most finance videos in Australia miss the point. They either throw around headlines like huge tax cuts are here, without ever telling you what that actually means in dollars, or they drown you in government language that nobody enjoys reading. Most people don't want legislation explained to them. They just want someone to sit down and say, mate, here's what's changing, here's how much you'll probably get, and here's what it actually means for your wallet. Because at the end of the day, a tax cut doesn't really help if you don't understand it. If you don't know what you're getting or what to do with it, that extra money usually disappears into everyday spending before you even realize it was there. So in this video, we're going to keep it simple. I'll walk you through exactly what's changing with Australian income tax from the 1st of July 2026, what it looks like if you're earning around $50,000, $90,000 or $130,000 a year, and whether these changes are actually worth getting excited about. Now look, I'm not here to tell you this is some massive life-changing payday because it's not. But I'm also not going to tell you it's nothing because that's not true either. Let's just have a proper look at what it actually means. So what's actually changing? Well, there's really only one major tax change happening from the 1st of July 2026. The tax rate on the income you earn between $18,201 and $45,000 drops from 16% to 15%. That's it. One tax bracket, 1 percentage point. Sounds pretty small, right? And I know what you're probably thinking. 1%. Is that really worth talking about? Fair question. But here's the bit a lot of people miss. That 1% applies to every taxable dollar you earn within that income range. So if you're earning $45,000 a year or more, you get the full benefit of that change, which works out to roughly $268 a year. If you're earning less than $45,000, you'll still benefit, you'll just get a little less depending on your income. There's another change that's been proposed as well, a $1,000 instant tax deduction. The idea is to make tax time easier by letting eligible Australians claim a standard deduction instead of listing every single work-related expense. If it goes ahead as planned, it'll be available to eligible taxpayers, but because it's still subject to the final legislation, it's worth checking the latest rules before you lodge your tax return. There's also something called the Working Australians Tax Offset, or WATO. Now this one often gets mixed up with the 2026 tax changes, but it's actually expected to begin from the 2027-28 financial year if the legislation passes, so it's not part of this year's tax return. If it goes ahead, eligible workers could receive an additional tax offset of up to $250 a year, so that's basically the big picture. But percentages and government announcements don't really mean much until you compare them with real incomes. That's where it starts making sense. Let's start with someone earning around $50,000 a year. That's a pretty common income if you're earlier in your career or working full-time in retail, hospitality, administration, or an entry-level trade. At this income, you're getting pretty much the full benefit from that 1% tax cut because you've already earned above that $45,000 threshold. Realistically, you're looking at around $260 to $270 extra across the year from the rate change alone. Then if the $1,000 instant deduction goes ahead and you're eligible for it, depending on your tax rate, that could be worth roughly another $150 or so at tax time. Now let's be honest. A few $100s isn't going to completely change your life, but here's where people make the mistake. They look at a number like that and think, it's not worth worrying about. The thing is, those few $100s might cover a few weeks of fuel, help pay your phone bill, or simply stop you dipping into your savings during a tight month. It's not life-changing, but it's definitely useful if you actually notice it. Now let's move up to someone earning around $90,000 a year, which is pretty close to the average full-time salary in Australia. This is where a lot of people watching will probably fall. At 90 grand, you still receive the full $268 benefit from the tax rate cut. On top of that, because you're paying tax at a higher marginal rate, the proposed $1,000 instant deduction is worth a little bit more than it was in the $50,000 example. Once you combine both changes, you're realistically looking at somewhere around $400 to $450 across the year. Now here's the trap people fall into at this income. They hear tax cut and automatically think it's going to solve the cost of living problem. Unfortunately, it won't. Yes, an extra few $100s is always nice to have, but it's nowhere near enough to offset what rent, groceries, insurance, and other everyday costs have done over the past few years. It's definitely helpful, just don't expect miracles. This is also the point where it's worth looking beyond the instant deduction. If your actual work-related expenses are higher than the standard $1,000 deduction, you could actually be better off claiming those instead. So it's worth checking your own situation rather than automatically taking the easier option. Now let's look at someone earning around $130,000 a year. Maybe you're in a senior position, running your own trade business, or you've built up a solid career over the years. Here's something that surprises a lot of people. Even though you're earning much more, you don't get a bigger benefit from this particular tax cut. Why? Because that 1% reduction only applies to income between $18,201 and $45,000. Once you've received the maximum benefit from that part of the tax bracket, earning another $50,000 or $60,000 doesn't increase it. Sure, the instant deduction could be worth a little more because of your higher tax rate, but overall, the tax cut actually represents a much smaller percentage of your total income than it does for someone earning $50,000 a year. And that's why higher income earners shouldn't rely on small tax cuts to build wealth. At this income level, strategies like making extra super contributions, salary sacrificing, or investing tax efficiently usually have a much bigger impact than a 1% adjustment to one tax bracket. So really the biggest takeaway isn't asking, how much extra money am I getting? The better question is, what am I actually going to do with it? Because this is what happens to almost everyone. A little extra money lands in the account every pay cycle. You grab a couple more coffees, maybe order Uber Eats one extra night, spend a little here and there, and before you know it, 12 months have gone by and you honestly couldn't tell anyone where that money disappeared to. If you're earning around $50,000, you'll get a small but useful boost that most people underestimate. Around $90,000, you'll get a decent little bump, but it won't magically fix rising living costs. And if you're earning $130,000 or more, the benefit is actually smaller than many people expect because this particular tax cut isn't designed to reward higher incomes. At the end of the day, the biggest mistake people make isn't misunderstanding the tax rates. It's never deciding what that extra money is for before it arrives. Once it lands in the same bank account as everything else, it usually gets spent like everything else. So if this video helped clear things up and made these tax changes a little easier to understand, send it to that mate who's guaranteed to bring up the new tax cuts at the next barbecue without actually knowing how they work. Because whether you notice it or not, that little bit of extra money is likely coming your way. What you do with it after that, well, that's completely up to you.